People often imagine Europe's rise in the 17th century as the product of clever statesmanship, brave explorers, and the hard work of European laborers. Yet this story hides a contradiction so deep it reshapes everything we think we know about global economic power. Wealth was flowing in unprecedented volumes, yet vast colonies remained impoverished. Nations claimed to build empires for civilization and trade, yet dependency and extraction were enforced systematically. The mystery is not whether wealth existed, it's where it actually traveled, invisible to the eyes of those who labored to produce it. At the heart of this hidden story lies silver, flowing not as currency for the colonies that mined it, but as the lifeblood of European expansion. The New World became a vast reservoir where silver extracted from mines in Potosi and Peru moved quietly through shipping routes that stitched together Europe, Africa, and the Americas. These hidden rivers of precious metal were the foundation for imperial power, yet their movement was meticulously designed to favor metropolitan centers over colonial communities. The 17th century marked the emergence of a globalized economy, but one carefully structured by elites. European empires did not stumble into riches. They built frameworks that redirected wealth along invisible channels. Colonial territories were engineered less for local prosperity and more for extraction, and even laws framed as protection or regulation often served to reinforce systemic inequality. Atlantic trade networks connected three continents in ways that were highly orchestrated. The Americas supplied raw materials and silver, Europe provided manufactured goods, and Africa was violently integrated as a source of enslaved labor. These networks were not accidental. They were maintained through law, monopoly, and the coercive presence of militaries on land and sea. Every shipment carried a hidden purpose: to consolidate wealth in imperial capitals. Mercantilism provided the ideological underpinning for these flows. It treated wealth as finite, a zero-sum game where the accumulation of bullion equated to national power. Colonies were instruments, not partners. Their primary role was to export resources cheaply and import finished goods expensively, creating a permanent trade imbalance that favored European empires and entrenched colonial dependency. Chartered companies became the operational machinery of this system. The Dutch West India Company, the English Royal African Company, and similar entities were granted monopolies, military backing, and legal authority. They blurred the line between commerce and governance, ensuring that trade decisions aligned with state priorities rather than local interests. The profits were concentrated in metropolitan centers, not scattered across the colonies. Shipping routes reveal the deliberate nature of control. Ports were authorized selectively. Merchants were restricted in whom they could trade with. Even if a colonial producer could fetch a higher price in a foreign market, imperial law often prohibited it. The result was a legal but invisible transfer of wealth from the places of production to distant treasuries in Europe. Silver flows tell the story most clearly. Mines in Spanish America produced staggering amounts, yet the metal rarely circulated locally. Instead, it moved to pay European debts, fund wars, and stabilize royal finances. The colonies were rich in resources but poor in autonomy, a contradiction that persisted across decades and continents. Plantation economies added further layers of engineered dependence. Sugar, tobacco, and cotton generated enormous revenue, but required extensive credit, insurance, and shipping services controlled by European. Colonial producers found themselves perpetually indebted, tethered to metropolitan institutions that profited regardless of production outcomes. The origins of this system lay in early policy decisions designed to secure imperial stability over local resilience. Laws dictated what could be grown, sold, and transported. While these rules were framed as protective measures, their economic impact consistently weakened colonial autonomy, ensuring that profits accrued in Europe rather than in the Americas. As trade volumes expanded, financial instruments became increasingly sophisticated. Bills of exchange, early banking systems, and maritime insurance reduced risk for investors in London, Amsterdam, and Seville, while transferring uncertainty onto colonial producers. When losses occurred, they were localized. When profits accrued, they flowed upward. The expansion phase created an illusion of shared prosperity. Ports thrived, ships multiplied, and trade seemed robust. Yet beneath the surface, wealth accumulation followed predictable patterns. The more trade increased, the more dependent colonies became on European markets and imperial credit systems. Strains emerged, with shocks to the system. Wars disrupted shipping lanes, piracy raised insurance costs, and fluctuations in European demand triggered sudden downturns in colonial economies. These crises highlighted how little control colonial populations had over their own economic fate. Taxation intensified during these moments. Empires raised duties and fees to fund military campaigns, extracting wealth precisely when colonies were least able to pay. The system reinforced dependency and resentment, while consolidating fiscal power in metropolitan centers. Monopolies hardened during periods of instability. Rather than loosening control, empires tightened restrictions, limiting trade freedoms to protect metropolitan interests. Colonial merchants became trapped between falling prices and rising costs, caught in structural rather than temporary crises. Crises were often blamed on local mismanagement. Plantation failures or port stagnation were framed as inefficiency, obscuring systemic origins. Colonial populations bore the burden, while metropolitan elites profited from the concentrated wealth flowing from these failures. Over time, consolidation accelerated. Fewer companies dominated trade, concentrating financial power in imperial capitals, where banks and investors could absorb shocks that devastated colonial producers. The system stabilized empires while hollowing out colonial economies. Boom and bust cycles, repeated with striking consistency. Resource prices surged, investment expanded, production grew, and then shifts in demand or credit tightened, transferring assets upward. The colonies experienced cycles of growth and collapse, while imperial centers consolidated wealth and power. Early trade systems normalized inequality by design. Profit was systematically separated from production, risk from reward, and power from accountability. These lessons would later underpin industrial capitalism and global financial systems. The long-term consequences extended far beyond the 17th century. Patterns of extraction, dependency, and inequality became embedded, shaping economic relationships even after formal colonial rule ended. Resource-rich regions remained economically fragile, while financial centers thrived on managing flows rather than producing goods. The uncomfortable truth is that modern global inequality traces its roots to these arrangements. Wealth did not accumulate solely through innovation or labor. It was engineered through rules favoring those who wrote them. Even today, echoes of the Atlantic system remain. Nations rich in resources struggle with debt, dependency, and limited industrial capacity, while financial centers flourish by managing capital and risk rather than production. The history is unsettling because it operated quietly. There were no dramatic thefts or obvious transfers. Value moved steadily, legally and invisibly, structured to appear neutral, while concentrating wealth far from the colonies. Understanding this history challenges myths of natural economic development. Growth for some was inseparable from constraint for others, and markets were shaped long before they appeared to function freely. The first takeaway is that economic power is rarely accidental. It is constructed through rules, institutions, and incentives that determine who benefits and who bears the cost. The second takeaway is that dependency is engineered, not natural. When regions are locked into specific roles, their struggles are predictable, structural outcomes rather than failures. The third takeaway is that inequality, once embedded in economic architecture, becomes self-reinforcing across generations, persisting even as political systems change. The warning is subtle but profound. Systems designed for control tend to outlast the empires that created them, shaping futures long after the original architects are gone. The hidden silver rivers did not merely transfer metal, they directed global power, influenced markets, and built financial empires whose legacies persist today. Understanding their pathways is key to understanding global inequality. If this story reshapes how you view the origins of European expansion and global wealth, the real question becomes what other invisible systems operate quietly today, shaping outcomes we accept as inevitable. History does not end with answers, but with awareness. And awareness, once gained, changes how we see the world we continue to inhabit.